It's a pleasure and honor for me to welcome all of you to our online seminar focused on investment and ideas in the bond market. I'm Sergey Lyalin. I'm founder and CEO of Cbonds. As you may know, Cbonds is a data provider. We provide data on financial markets with a main focus on bond market. And also, Cbonds is a conference house arranging conferences in many countries. As for now, we have hopefully temporarily converted all our events into online format. So we are arranging online seminars in Russian, in English, in Spanish, and all of these online seminars have been successful. And I hope this one will also have a success, and we plan to continue such a practice in the future. The current situation in the world is indeed very controversial. On the one hand, we have continuing COVID pandemic with more than 100,000 new cases reported every day. We have a very bad estimation for GDP in Eurozone, in US, in Russia for second quarter of this year. But despite all of that, we see that some stock markets, like for example Nasdaq, are on their historical high, and bond yields in many countries, like in dollar area, like in Russia, are on their historical lows. But for bonds, it's more complicated. That in some areas we see bond yields are higher than they used to be, like in Eurozone. In most countries, the yields on bonds rise, and for some countries, like if you take 10-year government bonds in countries like Belgium, like France, like Ireland, they moved from negative yield area to a positive yield area. And of course, during last 3 months, we've seen a lot of rating actions, and I suppose 100% of them were negative, obviously. Probably a speaker from Fitch Ratings will deliver some more information about that. And also, we've seen a sharp increase in a number of defaults. I've made a very simple search at Cbonds for defaults on internationally issued bonds for 3 months. And for a period from December last year to February this year, the number of defaults, the number of bonds that have defaulted were just 10. 10 bonds in the whole universe of internationally issued bonds. For 3 months, from March to May this year, the number of bonds that defaulted were 81. So it's 8-time increase in the defaults for bond market. All that means that investors should be very careful in taking their investment decision in such a risky and controversial environment with high risk and low yields. And that, of course, means that investors need a reliable data platform where they can take information on bonds, on ratings, on macro indices. And for many investors, Cbonds is such a platform. And I know that we have many current subscribers who are participating in today's webinar, and also hope that those who are not yet subscribed will join us soon. And at the end of today's webinar, we will have a presentation on Cbonds as a data platform made by my colleague, our representative in UK, William Clark. Some brief outline of today's agenda. First, we'll have a presentation from Brian Colton, Chief Economist at Fitch Ratings. Our second speaker will be Mark Gross, Managing Director at a company called Westwood Capital. And then we'll have a kind of panel discussion where you can ask your question to our experts. And it's very important that online seminars are very interactive. We have a chat on your right hand where you can put your question, and during a discussion, we will ask our expert to answer the questions that you will put them. So feel free to ask your question. And finally, at the end, my colleague William Clark will make a presentation on Cbonds as a data platform. So now I'm leaving the floor to William, who will be moderating today's agenda, and he will introduce our speakers. Thank you very much.
So, thank you very much, Sergey, for that lovely introduction. So my name is Will Clark, and as Sergey mentioned, I'm the International Partnership Manager for the UK and US markets at Cbonds. So I'll be moderating the webinar today. As Sergey already mentioned, Cbonds held conferences all over the world in the past, and this year we've had to switch to an online format. Obviously, one of the benefits of this is we can welcome people from all over the world. In the past, we've held conferences in London, and we've timed the conference this time, so we've got a speaker coming from New York and another one from London. So we're very happy to welcome both of them. As Sergey already mentioned, today's conference is going to be split into 3 sections. So during the first section, we will invite our speakers to deliver their presentations. The second section, we will invite you all to contribute your questions, and I will then moderate them to the presenters. And then, as the last part Sergey mentioned, I will be giving a short and brief presentation of the Cbonds platform. So without further ado, our first speaker today is Brian Houghton, the Chief Economist at Fitch Ratings based in London. So Brian has been with Fitch Ratings since October 2015 as their Chief Economist. Before that, he was at Legal and General Investment Management in London, where he worked as the emerging market strategist. And prior to that, he worked for the Sovereign Group at Fitch Ratings, which included spells in Hong Kong as the head of Asia Pacific Sovereigns. He was formerly an economics advisor to Her Majesty's Treasury, and he has a master's degree in economics from the University of Warwick and a BSc in economics from the University of Wales. The title of Brian's presentation today is Global Economic Outlook, a long and slow climb back. So, Brian, over to you.
Thank you to Cbonds for inviting me along. I just want to talk to you about how we're seeing the world economic outlook in this extraordinary times. I'm really just sort of drawing the contrast that Sergey's already pointed out between the exuberance in the markets and what is still a very, very tough global economic outlook, where we see the return to some semblance of normality is actually going to be a pretty slow and tortuous process that's going to be characterized by downside risk. So, yeah, that's the title of my presentation, A Long and Slow Climb Back. In many ways, one of the biggest challenges for us as economists has been trying to find enough superlatives to describe how outside of anything we expected this scenario is. And we've been seriously overusing the word unprecedented, but I've used it again here. This chart just summarizes our latest assessment of global GDP, which, as you can see, we're looking at a decline of 4.6% this year, which would be more than twice as deep as the global recession that followed the global financial crisis in 2009. Easily the deepest global downturn since the Second World War, and various researchers have looked at even longer data periods, and we're talking the worst for 100 years. I've seen several comments along those lines. I think, as well as the depth of this recession, the other clearly highly unusual feature is the speed at which it's happened. Normally, when we get a slowdown in an economy heading into recession, this is something that pans out over a year, 18 months sort of period. This has all happened immensely quickly. The decline that we think is happening in economies as they've gone into lockdowns, we think many economies are down 20, 30% relative to normal levels in the most stringent period of the lockdown, and that's what we think has happened in the US, 20% down. That's an equivalent decline, peak to trough, as was seen in the US economy in the Great Depression. So between December 1929 and the third quarter of 1931, US real GDP declined peak to trough by 20%. But that took 3 years. We've had the same decline in US GDP, we think, and it's happened in the course of 4 or 5 weeks. So the speed at which this has unfolded has been really quite staggering. We have continued to be downgrading our forecasts in recent months. Recent weeks, we published our latest forecast a couple of weeks ago. There were further downgrades in that forecast, and one of the biggest areas where we took the knife was actually emerging markets, excluding China. And again, this is another good sort of unprecedented chart to show you, which is an estimate that we have of emerging market aggregate GDP growth. We construct this series back to the early 1990s. This has never before shown a negative number for year on year, but we've now got Chinese growth down at 0.7, the only positive growth rate we have, but it's very, very low. And with those other numbers that I'll show you in a second, we now think that emerging market GDP is going to shrink. So again, completely outside of anything we've ever seen before, shrinking emerging market GDP. This chart shows you the precise numbers, and you can see the blue dots on this slide are the previous forecasts that we published in late April. Those themselves entailed a huge downgrade from the previous forecasts in early April, which in turn were downgraded massively from the previous forecasts in late March. You can see we've been updating these very, very frequently. We did make further adjustments in our latest adjustment in May. As you can see, the bars generally more negative than the blue dots, and the biggest downward adjustments that we made in late May were to the Eurozone, the UK, and to emerging markets ex-China. Now, in the Eurozone, the story in terms of the further downgrades that we felt we had to make was really about the incoming data telling us that the shock to GDP in France, Italy, Spain, amidst the lockdown period was deeper than we thought. It looked more like 30, even 35% down relative to normal in those countries, whereas previously we had been assuming a shock of more like 25%. For the UK, it's been more a story of the lockdown lasting longer than we expected. We're now in the 12th week, towards the end of the 12th week. We've previously been assuming that things last about 8 or 9 weeks. So it's not the case that the lockdowns had a bigger impact on the economy than we thought in the UK, but it's just lasting a lot longer. It's taken a lot longer for the new cases to fall and the government's become comfortable with only very recently starting to ease the lockdown. The biggest revisions we made in our latest update were to EMX China, as I mentioned, in particular India, where the lockdown has lasted a lot longer than we thought. It's been very, very stringent, and the incoming data flow has been truly appalling. So we've now got -5% for India. But big picture, no country has really escaped this. Just positive growth in China, but it's across the board. The breadth, the depth, the speed of this has been really, really striking. I suppose if we wanted to start to think about some of the, I won't say more positive, but less negative aspects of here, is that our own forecasts are starting to stabilize in the sense of the delta from forecast to forecast and getting smaller. So we continue to downgrade, but by less and less amounts. Our previous world number for growth was -3.9, so we only took 0.5% in the latest 0.5% off in the latest update. And a number of countries, our late May update, actually affirmed the previous forecast. So for the US, for China, for Japan, South Korea, Australia, South Africa, all of those forecasts were affirmed in our latest update. We didn't make further cuts. Again, with a big contrast to our previous iterations where we had to downgrade almost every country in our 20-country portfolio that we follow in our global economic outlook. So in terms of the delta in our forecast, I think we can say some signs of stabilization are starting to emerge. And I think we're also seeing that in the economic data. So a number of surveys, including the PMIs that you've all seen, starting to show signs of improvement, although it's still below 50. So technically, it should mean things are worse in May than they were in April. But I think our view is that firms are probably answering these questions in terms of how are things looking relative to normal. I think there's a number of other indicators that we've been looking at which also confirm that it does appear that the trough in global activity was probably in April, and things have improved slightly on the sequential side. So the PMIs are consistent with that. We have a number of bespoke high frequency economic activity trackers that we've had to develop because we just can't wait for the quarterly data before we just decide what the picture is. And on this basis, it does look as if US economic activity bottomed out in April. The last 3 or 4 weeks, which go up to sort of the third or fourth week in May, I think this chart goes to show things slightly improving. And we published a monthly version of this yesterday, which some of you may have seen reference to recently. So yeah, a number of the macro data releases that we're seeing coming through consistent with this view that April was probably the trough here. And we've been looking very closely at what's been happening in lockdowns. Just to sort of set the context here, one thing that's been very clear to us as we've gone through the numbers and been monitoring the situation is that not all lockdowns have been created equal. So what we've done here on this slide in front of you is we have done a scatter diagram of an independent measure of the stringency of lockdowns by the University of Oxford. We've taken the second half of April as the observation here, when all these countries were pretty much in full lockdown, and we've plotted that against high frequency of daily data from the Google Mobility reports on visits to retail and recreation venues in each country relative to their pre-virus average. So the vertical axis here is the shortfall of the number of visits in each country to retail and recreation venues as a percentage of the level of visits in January and February. And as you can see, the countries with the more lockdowns have seen the bigger declines in mobility in the second half of 2018. That's quite important for understanding some of the pictures that are starting to emerge in the macro data, because what's been happening since late April, early May is that lockdowns have started to be eased quite significantly in some places, and particularly Italy and France, I think, are quite striking. Those two countries had two of the most severe lockdowns of any of the G7 countries, but they've both been able to ease the lockdown significantly in recent weeks, in contrast to, say, the UK, where we've not seen anything like as significant an easing in the stringency of the lockdown. And as that easing in the stringency has happened in Italy and France, what we're seeing correspond to that is quite a big improvement in this mobility data. So more and more people going back to shopping centres, going back to restaurants, going back to recreation venues. And we think that is another sign that activity is picking up, that will increasingly be reflected in the macroeconomic data as that comes through. But we're able to monitor this on a daily basis. So I think that is a source for optimism. We probably passed the worst here, provided we don't get a second wave of the virus. I'll come back to that downside risk later on. But the other aspect of the numbers, which is giving us a little bit of confidence in terms of this view that things should improve, is what happened in China. It was obviously the first country to go into a lockdown and then emerge from it at the end of Q1. And what we've seen in China when we're looking at the industrial production data, which is some of the highest quality data that we think we can get out of China, and it is produced on a monthly, seasonally adjusted sequential basis. And on that basis, the Chinese industrial sector re-emerged back to the levels of activity seen before the virus, as of April. So the picture that's emerging in China, I think, is one that gives us a little bit of confidence as well, that as these lockdowns are eased, we will see this sequential pickup in GDP in May versus April. The other aspect, which I think is increasingly important, and is lending a slightly less negative tone to our commentary, is just the scale of the stimulus, which is both enormous and continues to increase. So we published a piece recently where we looked at the different types of macro policy stimulus measures that have been announced across the 20 countries we cover in our report. And these numbers are just simply staggering in their scale. So what we have on this chart is a whole bunch of measures, including the fiscal guarantee, some quasi-fiscal measures, new QE announcements, liquidity and refinancing facilities that have been introduced by central banks. But if you just look at the fiscal measures, so this is direct stuff. So this is increased government spending, cuts in taxes. Just looking at those numbers alone, we think that there has been $5 trillion worth of direct fiscal easing announcements in response to this crisis from the fixed 20 countries that we cover in our GEO reports. That 7% is enormous in its own right, but it's much bigger than we think than happened after the global financial crisis. For the advanced countries, we saw fiscal easing about 3 or 4% of GDP back then. We also think that fiscal multipliers should be fairly decent, fairly strong at this point in the cycle, given the negative output gap. So, these measures are definitely going to make a difference. There's no doubt about it, and they're being scaled up. We published this report last Wednesday. By Thursday, it was out of date because Germany had announced further easing, and the ECB had already scaled things up. It's clear that this easing is making a difference. And just before I turn to a chart of bank lending, this I think is a nice summary. What we try and do here is add up all of the global QE programs that we've seen for the major central banks: Fed, ECB, Bank of England, Bank of Japan. It's all expressed in dollar terms, and we think in 2020 we're going to see $6 to $6.5 trillion of global QE this year, led by the Fed, but the ECB increasingly playing a part. That's equivalent to almost half of what we saw in the entire QE period over 2009 to 2018. So in 1 year, banks are pumping in as much liquidity as they did half as much liquidity again as they did of the entire 2009 to 2018 period. So simply staggering the amount of central bank liquidity that's going into the system. And this is getting to the private sector economy. So, one thing that you normally see when recessions this severe happen is that bank lending becomes a negative multiplier, a source of pro-cyclicality. Credit conditions tighten, banks get worried, they stop lending. We've seen the opposite of that. So measures of bank lending to the corporate sector have surged ahead in both the US and the Eurozone and the UK as well. And we've seen this massive surge in corporate bond issuance, as you're aware of. So credit to the private sector, or credit to the corporate sector at least, is rising very rapidly. And that has a lot to do with those guarantee schemes and that liquidity. So it's clear that these policy responses are certainly making a difference. However, despite the aggressiveness of the easing, we still don't think this is going to translate to a particularly rapid recovery. And this is partly because we think firms are going to be extremely cautious. When we talk to our corporate credit experts at Fitch, they say that companies are going to be slashing capex. And we're seeing that in the survey numbers. So I've got two surveys here showing you the intentions of UK firms on the investment side at record lows, and a similar pattern for the Eurozone as well. So we don't think that additional credit is going to be going into additional capex. It's certainly going to be cushioning the blow, but it's not going to unleash a wave of capex. We think corporates will remain very, very cautious going forward, and that's one of the important drags on the economy as the recovery unfolds. And of course, we've had this massive shock to the labour market. Although the figures for May were better than everybody expected, and things did come down. The reality is that this is a massive rupture to the labour market in the US. We're seeing similar numbers. We're seeing rises in unemployment come out elsewhere as well, and we think this is going to be an important factor in pushing up saving rates for quite a period of time in the household sector. And this is going to weigh on household spending for quite some time. When we look at the monthly data for US consumption, we see quite a striking pattern in April where actually there was an improvement in disposable income because there were massive tax handouts, but the consumer spending fell precipitously. A massive surge in the saving ratio. Now, that's probably a bit of a statistical aberration in terms of the extent, the 33%, whatever the number is. We don't think it's going to stay that high, but it's certainly going to remain elevated for a while, we think, because of this increased job uncertainty after such a massive shock to the job market. So that job uncertainty itself will keep the consumer from recovering rapidly. But over and above that, of course, we are going to have, even if the official restrictions are eased, we're going to have voluntary social distancing behaviour. It's going to be affecting consumption for quite a while. And this, I think, is something that's also borne out by the Chinese data. I showed you the industrial data earlier, showing quite a strong recovery, but the consumer in China has really lagged the industrial sector, and we've seen that in the retail sales numbers. Our sovereign rating team has done a lot of work on what's happening in the Chinese labour market. We think there's a big job problem there, and we also have issues. There's clear evidence of social distancing behaviour affecting the recovery in consumption. So the consumer is going to lag for both of those reasons. So when we try and put this picture together, a sort of renormalization of the economies as lockdowns are eased, massive fiscal and monetary stimulus, but corporate sector caution and household sector caution, ongoing social distancing. This is the picture that we come up with for the recovery path. We do get a decent sequential recovery in the second half of 2020, but then it sort of loses a bit of pace. And the bottom line is that even by the end of 2021, which is our forecast horizon, we do not see GDP having retained its pre-virus levels. So we don't get back to Q4 19 levels in the US by the end of next year. We're 1% below in the US by Q4 2021, more like 3% below in the Eurozone and the UK. So that's really how we see this recovery panning out. It's going to be quite a long, slow haul back towards some sort of normality. We also started to have to think about the more medium-term outlook, what happens after 2020, 21, the recession and the sort of technical bounce back from that. And there are two ways to look at this. One is that, well, there's no real supply-side damage being done to the economy, and therefore, over the next 5 years, say, you should get back to the pre-virus trend. If you believe that to be the case, then the economy, this is the US economy I'm showing you here, would probably take something like the blue path on this slide, which would imply quite rapid growth from 2022. The numbers here show 3% per year on average after 2022, because there will then be, if there's been no supply side damage, there will be a very large negative output gap that we would expect to be closed by the middle of the decade. Unfortunately, that's not really how we're seeing it at the moment. We think it's more likely to follow something along the lines of the green path here, which is that the economy grows more or less in line with long-run averages after 2021, and we don't really get back to that pre-virus GDP path. So, and that's partly because we do see the rise in unemployment, the decline in capex, going to have an impact on potential growth over the next 5 years. So it adds up to the story of the economy remaining well below where we thought it would be right through the medium term. And of course, that's all on the basis of our base case, where we think resurgence of the virus can be avoided. As we've all been watching, The virus infection rate, the so-called R rates, that has come down as countries have gone into social distancing and lockdown policies. But as those lockdown policies are eased, scientists seem to think there's a good chance that the infection rate will go up again. So we have put together a downside scenario where that happens, and we do get renewed lockdowns later in the year, or with the existing lockdowns have to be extended. And there we see the outlook even bleaker than the one that I've described, with 12% decline across the board. So let me stop there and pass back.
So, thank you very much indeed, Brian. That was very interesting. I'd now like to introduce our second speaker, Mark Gross. Mark is Managing Director at Westwood Capital in New York. He has over 20 years' experience as a corporate and investment banker in the US, Brazil, LATAM, the Middle East, and Asia. He's also been CEO of American Express Bank, Brazil, and he was CEO of American Express Bank FSB in the United States. During his career, he's did M&A and capital market transactions of over $50 billion in the US and internationally. The title of Mark's presentation is Opportunities in USD Emerging Market Debt. I'll hand over to you, Mark. Thank you.
Good morning, good afternoon, good evening to everyone. Thank you, Sergey, Will, Maria, for the opportunity to speak today. As Will mentioned, I am joining you from New York City, where after about 3 months of lockdown, I'm delighted to be speaking to just about anybody. So it's great to be here. As Will mentioned, I am a managing director at Westwood Capital here in New York, where I focus on cross-border emerging markets debt. And that's what I'd like to talk to today. My intention here is to leave you with a framework for thinking about cross-border EM debt, the opportunities, how it's structured, what things should be relevant to you and what things less so. I want to just reinforce that we will be looking at a number of issues, but they're not specifically intended to be recommendations. They're more intended to help you understand how I approach this and how I think about it. And to that end, the ones that I'm showing, frankly, are the ones that I know the most about and can feel like I can speak to the most eloquently, not suggesting that these are the options in the market for you. With that, I will give you as I like to call it, a word from our lawyers. And some of it is what I just said, which is that the views that are expressed here are only my own, both in what I say and what we show in the presentation. They do not represent the opinions of my employer, Westwood Capital, or any previous entity or future entity that I may be affiliated with. The presentation itself does not constitute investment advice. It is not a recommendation to buy, sell, or hold any security, or an offer to buy or sell, or the solicitation of an offer to buy or sell any security. Any decision that you make based on our conversation here today can and must only be made through a thorough analysis by you, which this does not purport to be. And obviously that must take into account your own unique situations, your jurisdiction, your legal structure, your suitability, your objectives, etc., none of which obviously can be considered here. These securities are purely intended for informational and educational purposes, but I hope that they will give you a sense of, kind of how I think about emerging market risk and maybe offering you some advice in that regard as well. So with that, I'm actually going to take the liberty of turning off my video just so you'll be able to hopefully hear the sound a little better and we won't have any drop-offs. And I think listening to what I say for the next 20 minutes or so is probably going to be a little more interesting than looking at my quarantine haircut anyway. So I'm going to do that right now. Okay. So let's talk about what the world looks like today. And I think this is a great segue to the comments that Brian made, not least because they're accurate and sobering, but because we work very closely with Fitch in the US, and conveniently enough, the first couple of slides that I'm going to show you are provided to me by Fitch and pretty much mirror what you've, what you had just heard from Brian, which is, boy, what a difference 3 months makes, right? If we look at the emerging markets in their year-over-year growth in fourth quarter versus now, we see it.
Brian, sorry for interrupting. Can you please switch on your camera?
Okay, I just didn't want to have any drop-offs on the words.
Oh, okay. Brian, please switch on your camera and microphone.
Great. So anyway, as Brian mentioned, there's been a significant reversal in direction in the past 3 months, and that is even more acutely seen among the emerging markets than even in the developed markets in many respects. We see China going from an expectation of more than 6% growth year over year in fourth quarter, which, by the way, would be pretty slow for China's standards, right? To a significant reduction in first quarter this year, as we'll see coming up. They're expected to actually bounce back relatively more quickly than some of the others, but nonetheless, a significant difference. We see that the Southeast Asia countries, Malaysia, Indonesia, Philippines, significant declines. We're going to speak specifically about a number of Latin American countries, which is the area where I tend to focus. So you see Chile, Mexico. We're going to talk quite a bit about Brazil, and you'll see that as well. You see emerging Europe, all kind of, having the same, general pattern of things. Okay. So we're going to see a sharp deterioration year over year. We see emerging markets as a group, which is that second bar from your right, having a downturn as a group, and we see that Latin America, emerging Europe, being the worst benefactors of that, if you will. Emerging Asia actually does a little bit better, basically buoyed by China, which you can see on the right-hand side, which is the only positive at slightly over 1%, which at least is a step in the right direction, but obviously much lower than recent China performance and lower than certainly their own expectations. And we see that playing out both economically and, in my view, politically in the country. When we look at to the right of China, we see a situation that literally gets worse and worse, and especially as you get to the BRIC countries, Russia, not quite as bad as South Africa, Brazil, but India. But you see a trend that mirrors what Brian said, and really is not a great one. So what I want to do, and kind of the lead into what we wanted to talk about, is to kind of give you a sense of where US dollar borrowing rates have gone across these countries. So our focus here is on cross-border emerging markets debt. One of the benefits of that for investors is that it is always in a hard currency, usually in US dollars. You do see it in euros, you do see it in Swiss francs, you do see it in sterling, but most cross-border debt is in US dollars, and that is my focus, and that's kind of what I'm going to talk about here, just because that's what I can speak to most eloquently. But a couple of caveats as we're looking at this chart. First, it's a bit of an apples and orange mix. I tried to make that as least the case as possible, but in order to give things that kind of gave you a sense of the overall market, that was necessary, in the sense that what we're looking at are 10-year rates. So they're 10-year equivalent bonds. They are on maturity, not duration. So that makes them not quite in apples to apples comparison. They are, because they are 10-year equivalents that I wanted to show some history of, they're obviously not the benchmark because they're more than 10 years when they were first issued, which is how I got a year's worth of data. And even then, as you'll see, I wasn't able to get full year data for a couple of them, but we do kind of are able to see enough data there to kind of see a trend of what's going on, in these markets. I would also point out that this is intended to be illustrative, not exhaustive. There are a couple of notable exclusions: Russia, Indonesia, Thailand, India, and simply stated, that was because I could not find a liquid enough issue of a similar time period. So Russia does have some US dollar issues, for example, but they didn't have a 10-year, and they had an 8-ish and a little over 10. But when you looked at those numbers, it wasn't really a fair comparison. Other countries, Indonesia, India, have US dollar debt, but it wasn't very liquid. Thailand doesn't have US dollar debt. Two other names that are missing here are Lebanon and Ecuador, which up until recently were fairly heavily traded EM debt, but they are both in restricted default. But what you see, I think, is a pattern. And I'm going to go all the way to the right from the bottom up. And basically, the pattern that you see essentially are that countries with the highest credit rating did reasonably well, with very high credit ratings, did reasonably well to slightly improved after a bump, based on the current situation. Then as you go down the credit rating ladder, they move from slightly improved to slightly worse off to significantly worse off as you move up the credit ratings. So I'm going to take you up this list that might not be quite clear on the bottom and kind of give you a little more color. At the bottom, obviously, the most efficient US dollar borrower is the US at AAA and 72 basis points, that blue arrow bottom right. Above that is China at only a little bit more, 149 basis points for their US dollar 10-year issue. And as you can see, they are actually slightly better off than they were back in December anyway, on a rate basis after a bump up, which you see for everybody, right? Then you have Peru at in the yellow line at BBB plus, 2.04%, rather, sorry, 2.04%, just over 2% for a BBB plus. Panama above that, BBB at 2.3. Italy also BBB at a little higher, 3.4. Mexico above that, BBB minus at around the same rate as Italy, which kind of gives you a sense of how the market's viewing Italy. Probably not as a very strong BBB, but more like a BBB minus. Above Mexico in the brown line, we have Guatemala at BB minus and a little over 4%. And Brazil just above that, also at BB minus, but at a slightly worse 4.8%. Interestingly, above Brazil, the darker green line is South Africa at BB, ostensibly higher than Brazil, but at a 5.7% rate as of last Friday. And that's, I think, just reflects the ratings I just said are in deference to our co-sponsor Fitch. Those are the Fitch ratings. What we see in South Africa is actually a split rating, where Fitch is BB with a negative outlook. We actually have S&P at BB minus, which is where the market seems to be viewing South Africa, and Moody's, strangely enough, at BA1, which is equivalent to BB plus. So there's a little bit of schizophrenia around South Africa, but the market seems to be kind of congregating around the S&P rating. Similar above that is Turkey, BB minus, but there too it's a split rating. S&P single B plus, Moody's B1 with a negative outlook, and that seems to be where they're trading kind of a little bit lower than where Fitch has them laid out. But that's kind of how we see the market in general. And I think the takeaway here is that the worse the rating, the greater the spread relative to U.S. Treasuries has grown over the course of the pandemic. That said, there are two interesting opportunities, we think, in the markets, and they are companies that are significant exporters and quasi-sovereign issuers. And this is because, while it may seem to be an odd time to be talking about the emerging markets, especially with the sobering setup that Brian gave us, much of the world is laid low by the coronavirus. There are concerns about a second round, but nonetheless, this won't be forever. And I think that, in times of uncertainty like there are, these produce opportunities, particularly where we see spreads that have radically widened relative to both US dollars both the U.S. spreads rather, as well as their home currency spread that may represent an opportunity that is improved relative to where these guys were previously. So let's begin with emerging market exporters. Emerging markets are kind of notable in the sense that many emerging markets, maybe most, are characterized by being exporters of commodities and basic materials like steel, chemicals, petrochemicals, agricultural giants like Brazil, Mexico to a certain degree. And these exports are typically in hard currency, always in hard currency, virtually always in hard currency, typically in US dollars, and this presents a natural hedge opportunity for this hard currency denominated debt. Let's begin with one that I think proves the rule, because I don't think this is a particularly strong company, but it's an interesting one, and their bonds currently trade. And all of the information here about the individual companies comes from Cbonds, so things you can validate what I'm saying here, or use that to search for other opportunities that kind of play off some of the concepts that we're going to talk about here. But Adecco Agro is an Argentine commodity producer, cotton, soybeans, corn, and exporter. They operate principally in Argentina, but they have farmlands in adjacent countries, in Uruguay, I believe, and Colombia, and they are a large exporter of those commodities. What's interesting here, I think, is that despite the fact that its sovereign, Argentina, is in restricted default and is now trading at, where are they trading? Around 26%. We see Adecco Agro at just about 7.5%, well inside the sovereign because of those hard currency exports. That said, a significant increase in the gap to U.S. Treasuries, and this is a theme that I think you'll see in the additional examples that we show. This is a Brazilian company called JBS, one of the largest protein producer in the world, huge exporter, operator, not just in Brazil, but in the United States, where they own Swift, as well as in Europe, Asia, et cetera, where they have production facilities in addition to exports from their Brazil and Argentina operations. A number of the examples I'm going to show here are from Brazil. It's a market that I cover and know very well, and I think that underscores a point I wanted to make earlier, which is that I want to leave you with a way of thinking about these. I'm not suggesting that these are the best examples in the markets that you know better than I do. There may be even better examples of the concepts that I'm trying to illustrate here. There may be maturities for these individual issuers that are better suited to your needs. But again, it's really kind of getting across the concept of what's going on here, which is JBS is a massive multinational by any international standard. They actually trade one notch above the Brazil sovereign at BB relative to Brazil, which is BB minus. They are broadly international, which mitigates some of the country risk. And another point that I would make is, and this is common of issuances of emerging markets countries, is that their international issuances are frequently made not from the country but from offshore. So the actual issuer of this bond is JBS Investments, which is an Austrian company, which is useful because in bankruptcy, the regulations of the countries that issue these, which are typically Luxembourg, UK, Austria, I think is a common theme you'll see here, are much more beneficial to creditors than going after a Brazilian company in its local market, or a Russian company in its local market, or a Argentine company in its local market, et cetera. So that's a fairly common theme among international issuances, and that's a relevant one as well. But you see here too that at 5.9 they are trading above the Brazilian sovereign and at a significant and larger than normal spread to equivalent U.S. treasuries. A similar company, which nice to show these side by side, is Marfrig, which is the second largest protein producer in Brazil. They are not the second largest in the world. They're probably fourth or fifth, though. A couple other U.S. companies and others in between. They trade at the same as the sovereign, double B minus rather, but they're 150 basis points relative to JBS. The guarantor here too is their Netherlands entity, more favorable in bankruptcy. There too, they are a broadly international company. Most of their revenue actually comes from the U.S., where they are the owner of National Beef, which is the fourth largest beef producer in the U.S. So between their own beef production in Brazil and Argentina, which is pretty significant on its own, plus the U.S. national beef operation, they are, I believe, the third largest beef producer and the fourth or fifth largest overall protein producer globally. There too, a significant uptick from where they had previously traded. We're kind of getting to a revision of the mean as the lockdowns open and as things sort of settle out a bit. So I hate to say, boy, this would have been great a month ago, but boy, this would have been great a month ago. It's still kind of an interesting thing to take a look at today. This is Braskem, which is a Brazilian petrochemical exporter. Again, one of the largest in the world. One of the benefits of Brazil, which is also true of Russia, India, and some of the other BRICS as emerging markets, is that their multinationals are huge by any global standard, and they are not, and they typically do have U.S. issues. We're going to look at some Russian multinationals a little later down the line, but that's sort of a common theme, which is that they're the largest multinationals of the largest emerging markets are sort of always have hard currency issuances, and they're an interesting way to have a play on that country, by thinking about their larger multinationals and their quasi sovereigns, which we're going to talk about in the next section. But here, what's interesting to me about Braskem is that they have not really reverted to the norm. So they are not quite at their all-time high spread relative to U.S. Treasuries, but still at a significant spread. What's interesting to note about these guys too is that they're just a little more color on them. They're the world's largest producer of biopolymers and also resins, benzene, iopropene, and others. They have joint parent, which is Petrobras, the Brazilian national oil company, and Odebrecht, which is a large Brazilian construction company, which, not to take this off track, but Odebrecht itself is in bankruptcy due to a Brazilian scandal you may have heard of called Lava Jato, which had to do with Brazilian construction companies giving kickbacks to Brazilian politicians. So Odebrecht is kind of weighed down by that. Petrobras is a very strong company on their own, and both of them have announced that they will be floating Braskem, or either floating Braskem independently or selling it within the next year on a standalone basis. Braskem is a very strong company. You see that reflected in how it trades here. Another Brazilian company, Suzano, interesting. They are among the world's largest pulp producer and among the largest paper and pulp producers. So on the paper side, there are guys who are bigger than them, Kimberly-Clark and others. But just in terms of pulp, they are the world's largest, massive exporter to Europe and to Asia. There too, they traded very tight to U.S. rates as recently as February. You can see there's a massive bump up on a very strong company and one that is relatively resilient as a paper and pulp producer to economic downturns. That's, I guess, the point I wanted to make a little earlier too, which is that I tried to choose companies here that, in my opinion, are relatively resilient to economic downturns: food production, paper and pulp, petrochemicals. Maybe them a little bit less, but I think that's another thing to take into account here, is that these are not people that we would imagine would have a significant elasticity of demand based on the economic cycle. Last Brazilian in the set is, but same story, which is Vale, the world's largest iron ore producer and one of the largest mining companies. What I like about this one too is it's a particularly long play. It's a 22-year play, which is kind of difficult to find in emerging markets U.S. dollar debt. But they are very strongly linked to the Chinese economy, given that iron ore is a major component to steel. China is their single largest customer, but they are the world's largest, so they sell in lots of places. They are cyclical as a function of that, since their output principally goes into steel. And they have had some issues of their own. They had 2 slurry dam collapses over the past, I guess, 2 years. Both of them tragic. One extremely, with a very high loss of life a few months ago. So they're bouncing back from that, which has impacted their bond prices. But as a consequence of that and the pandemic, you can see that they're again at a significant premium to where they previously traded over equivalent U.S. Treasuries with a very long U.S. dollar denominated tenor. So I want to turn now from export-driven stocks to, actually one last word about export-traded stocks is several of them that I just covered, and should have said this at the time, actually trade better than their sovereign. So Vale, the one we just saw, which I can actually go back to, Vale actually is a triple B minus, as opposed to Brazil, which is a double B minus. The Suzano as well as triple B minus, as opposed to the country rating of double B minus. And again, this goes to the strength of their international operations, the level of their foreign currency reserves, the level of their foreign currency exports, and then I think kind of reinforces the point that I was trying to make. Turning to the quasi-sovereigns. First, what is a quasi-sovereign? A quasi-sovereign is an entity where the government owns at least 50% of the voting rights or the economic rights, of that company. They are not unique to emerging markets. Some exist, and especially banks, for example, can even exist in France and other European countries. But they're fairly commonly found in emerging markets. And this is because, in addition to the way that these countries evolved, they typically advance some policy function of that government. The desire to have foreign currency sales, their ability to help promote international expansion for these countries' companies generally. The domestic oil companies are a great example of this, and in any number of countries, this is the case in Russia, in Latin America, in the Middle East, etc. The domestic oil companies, as a group, are commonly classified as quasi-sovereigns, but this could also include banks, development entities, other natural resources producers like Codelco in Chile, which is the world's largest copper producer, also investment funds, Mubadala and others in the Middle East would all qualify as quasi-sovereigns. Interesting things about quasi-sovereigns is that while they do not have the explicit guarantee of the sovereign, they are believed to mostly have the guarantee of the sovereign. Fannie Mae, Freddie Mac in the United States, I think you could characterize them as quasi-sovereigns. They don't have the explicit guarantee of the United States government, but as we've seen in the housing crisis, the government did step in to prop them up. There was the perception that if they were allowed to fall, that would reflect poorly on the credit rating of their host government, even the U.S. in that situation. So I think there's a general perception that quasi-sovereigns, are interesting, are similar to the government risk, and it would be only a doomsday meltdown where the government would allow that quasi-sovereign to default, and yet they trade at premiums to the sovereign, frequently at significant premiums to the sovereign, and represent, we believe, an opportunity there. And as a group, I won't say quasi-sovereigns have never been allowed to fall or never been allowed to restructure, but as a group, quasi-sovereigns have have performed quite favorably to sovereigns over the past decade or two. And with that, we'll turn to one of my favorites, Brazil, BNDES, which is the Brazilian Development Bank, Banco Nacional de Desenvolvimento Econômico and Social, which is the Brazilian Development Bank for Social and Economic Development, and commonly is the so the Treasury, obviously, and the central bank manage the money supply, but the Brazilian Development Bank has been very active in providing low-cost loans at some controversy to Brazilian corporates, and has been accused of kind of picking winners and losers, in that regard, which is accurate. Some of the companies we just saw, JBS in particular, have been particular beneficiaries of these low interest loans. So nonetheless, though, they do very clearly advance the policy objectives of the Brazilian government. And we see here that they are trading at not only at a spread over equivalent U.S. Treasuries that is significantly higher than normal, but over the Brazilian equivalent, they're at 3.5, 3.6 almost, versus the Brazilian equivalent of 2.4, 110 basis point pickup over a sovereign, which many would regard as a similar kind of risk. I'm going a little out over my skis here, knowing that I'm speaking to a number of people that know a whole heck of a lot more about Russia than I do. But with that in mind, let's talk about Gazprom, also considered to be a quasi-sovereign. Same rating as the sovereign, BBB. Here, though, too, we see that same pickup. We see a little over 3% for Gazprom versus the Russian 9-year. There wasn't a Russian, mentioned up front, there isn't a Russian 10-year specifically. So not quite the same comparison, but a Russian 9-year at 250 versus a Gazprom 10-year at 307, which would be a nice pickup with the belief that Gazprom is a similar risk to the sovereign. One other interesting thing about Gazprom is that where many of the quasi-sovereigns have international issues only in US dollar, Gazprom is a much more of a broad range of issuances, a market agnostic, if you will, with yen, Swiss franc, euro, and sterling issuances as well. So if those are your home currencies and you're more comfortable with those than the US dollar, then Gazprom is an example of a quasi-sovereign that may very well have an issuance in your currency, that in a specific currency of your interest. Excuse me. Turning to Mexico, just to mix things up a little bit, and here too, I probably had too many Brazils up front. There are some, and to underscore my point that I didn't suggest that my list of exporters was exhaustive. One I probably should have covered, but didn't think about it until I sent these slides off for putting up today, is Grupo Bimbo, a Mexican multinational of bread, confectionery products, snack foods, also a global player by any international standard, also issuer of debt in US dollars and I believe euros as well. One that trades better than the better than the Mexican sovereign, and another interesting export-related one that probably should have covered back in that section, but My point simply is that just because I showed you Brazil doesn't mean there aren't other options as well. Using Mexico here as also another example of kind of mixing this up. Here too, you see that the oil companies understandably are dragged down not just by what's going on in the global economy, but by that particular impact to the oil and gas sector. That said, unless you believe that the national oil companies of these various countries are going out of business, which I do not, they are trading at significant premiums to the US rate than where they typically did, and significant premiums to the sovereign as well. Mexico, less so to the sovereign. The Mexican sovereign is around 3. These guys are only at about 310. So just a small pickup to the sovereign, but a significant pickup to the US dollar equivalent, especially relative to where these guys have traded in the past. So something to think about. Back to Brazil, Petrobras, same story. The Brazilian national oil company Petrobras currently trading at about 150 basis points over the equivalent Brazil, and at a higher than usual premium to the US dollar. Again, it's not just Brazil, it's a function of the the market's perception about oil and gas. But unless you think that the one national oil company of Brazil is going out of business, it's something to factor into your evaluation. One last national oil company, another one of my favorites, which is Sinopec, the Chinese national oil company. Same story here. China, as you saw early on, is trading very tight. They really haven't changed very much to the US. So what's interesting to me is neither has their national oil company, which I think the takeaway here for me is the national oil company clearly is a quasi-sovereign, right? It's essentially trading like the sovereign, which is trading like the US dollar. So you see that its spread moves almost exactly with the US dollar, but it is a significant pickup over that, and is a bit of a pickup over the China equivalent. And again, another one I like, that this is a 27-year play. So if you like China for 27 years, this is an interesting one for you. You do have to like oil and gas, and that's something to consider. On the other hand, Sinopec is not just an oil and gas producer. They're also the largest producer in China of petrochemicals, fertilizers, and other products. And their products are mostly consumed in the China, exclusively consumed really in the Chinese market. So even if you think that the West may take some action that would have a negative impact on oil companies, I think many people believe that China would at a minimum lag that by some period of time. So that's China. Just to wrap it up, as I said early on, to bring this back to my caveats, what I hope I presented here is just a way of thinking about emerging market risk. I say again, it was very Brazil heavy, and that's a function of my knowledge base, not a function of where opportunities may lie in the market. And I hope that I was just able to impart a way of thinking about this that you can apply to markets that you think that you know better than I do, and that you feel more comfortable with. There may be exporters on this list that I didn't cover that could be interesting. As I mentioned, Bimbo. I haven't covered any in India. Obviously, those would be ones worth taking a look at as well. I just didn't felt that I could speak to them as well as I could speak to some of the others. Even some of these issuers, there may be tenors that are more appropriate to your objectives or your risk profile. So these are not intended to be an indication of where I think you should rush into, but a way of thinking about what opportunities may exist that leave you that are suited to your risk profile. And just to leave you with one more thought about how to look at the markets, especially if you're looking to invest in hard currency and in a way that eliminates direct foreign currency exposure. And I say direct because foreign currency exposure never goes away. It's like a balloon. You squeeze it in one place, it comes out in another. So that is something to think about. And we can talk about that a little bit more in the Q&A if that is something you want to pursue. But at a minimum, these would be without the direct foreign currency exposure. There are, again, to reiterate, there are markets that I think could be quite interesting that I did not speak to here: Russia, Indonesia, Malaysia, emerging market Europe, Poland especially within that latter group. And those would certainly be places that I would be looking at for opportunities as well. But again, I hope I left you with something here in terms of a way to think about this going forward. So thanks again for your time. And thanks, Will. Thanks, Sergey. And back to you.
So thank you very much, Mark. So now we'll have some questions and answers. The first question I think I'm going to ask to you actually, Mark, because it's something you've touched on a little already. The question is, which sector would you focus on for investments, which will show improvement post-pandemic in the period of the second half of 2020 to 21? So, and actually, I also ask everyone if they're not talking to turn off the microphone, because I'm getting an echo right now. Thank you, Mark. So, yeah, the question I would start with you, Mark, would be which sectors should show improvement post-pandemic in the second half of 2020 to 21?
Yeah, I'd say the one that will show the most improvement, in my view, is oil and gas, right? I mean, we see there's a logical reason why oil and gas is having the effect that it is. I don't think oil and gas are going away in 3 months, 6 months, a year, or however long it takes to really go through this. I think we will return to some semblance of normalcy. We will have some amount of air travel. We will have some amount of automobile travel. I think we see them being weighed down, by that. Most of these guys are not particularly over leveraged. And I think that those guys probably have the most opportunity for bounce back. And as you saw, I think they had the most differential relative to where they had been trading previously. So that's where I would see the most improvement. The one where I would see the most stability, and the one that I like best, really is in food, right? I mean, food is not particularly susceptible, we hope, to global, to the current environment. In fact, we've seen an increase in demand for food supplies as some of the food chain has been disrupted. But the food producers, I think, are an interesting one. They're really not going anywhere. And even there, I think we see some opportunities that, where they would kind of tighten down the line.
Okay, thank you, Mark. And Brian, would you have anything to add on that?
Really just from a sort of economic perspective rather than investment perspective. But I think, I think maybe one of the themes we've got to see is the Chinese economy comes back, and that's already happening and continues. And Asia in many ways looking further ahead in terms of the sort of kind of normalization curve. I think we might sort of see the industrial side of manufacturing looking a little bit better relative to the sort of consumer service side, which are going to continue to be affected by sort of social distancing behavior and ongoing restrictions. So I think that split on the economic side will be an interesting theme to watch.
Okay, thank you, Brian. I've got one now which is quite topical and a little bit offbeat, but I think it could be quite interesting for you to look into, Brian. The 1918 Spanish flu pandemic had no discernible impact on the aggregate US economy, so plus 1% growth in GNP in 1919, despite higher mortality. So what's the difference now?
Yeah, I've looked into this a little bit. I don't know if we can really draw too much from that episode. The quality of the data back then, there was a world war that had just ended, pretty volatile period. I think the strongest conclusion from that episode, I think, is that we can look at various US states and provinces and cities that did apply social distancing policies and ones that didn't, and clearly the ones that did do the social distancing fared better in terms of the spread of the virus. But beyond that, I think it's really hard to draw conclusions about the economic impact from what happened back then. You know, the state of medicine, modern medicine, is surely 100 years of progress on that front must make quite a bit of difference as well, I would have thought. But I'm not an expert on that.
Totally. And Mark, do you have anything to add on the parallels with the Spanish flu?
No, I don't. I'll pick up on, not in the position I feel to kind of make a projection about that. One thing I would pick up on that Brian said is that I think that there is, how China bounces back really is a factor. China recently surpassed the U.S. As Brazil's and Latin America's largest trading partner. I think they've actually drifted back now that China's growth has slowed a bit, but China's clearly an important player in Latin America generally, Brazil specifically. I think you see that more, well, you see that across the board, but where I think you'd see the biggest pickup is in Vale, right? Vale is a major iron ore supplier to China. With China's growth sliding, that has had a major impact on iron ore prices. You don't even have to look at Vale, you can just look at iron ore prices globally and see what's happened there. And that really is very much China driven. On the food side, China is a big off-taker of Brazilian and Latin American protein as well. So I think that there would be a pickup there, but the food sector has been relatively impervious to the turn down. So I don't think that has been affected so much, but I'd see minor pickup there, real pickup on the hard commodity side.
Sure. So moving on from that a little bit, Mark, which economies would you say in EM are best positioned for the restructuring of debt by extending maturities and lowering rates?
Argentina, right? I think it's the answer, right? Argentina is in restrictive default. Look, I think that this situation is rough for everybody. Brazil, if you've been following the news, has been particularly hard hit by the pandemic. They have, in my view, and that of many medical professionals, really not handled the situation very well. Arguably worse than the U.S., which is kind of hard to beat. But economically, Brazil is not has strong exports, has strong foreign currency reserves. I don't anticipate. They have drifted from their investment grade down to double B minus. I think they're on double B minus. I think we're on a negative outlook from Fitch. Maybe that would happen, but Brazil is not going out of business. I mean, the only one that's really, I think, in particularly dire straits is Argentina. So I think Argentina would be the one where that would be the case.
And Brian, do you have anything to add to that?
Not really on the debt restructuring front. No, I'm not sure I've got much to add there. Sorry.
Okay, so I've got a question which might be quite interesting for you, Brian. Which markets do you consider to be the most curious for investments in respect of some yield versus the horizon for ratings change? So which markets do you think would be the most interesting in that respect? Yeah,
again, this is difficult for me to comment on in terms of market pricing and spreads. We can't really give advice on that front. So I'll bring it back to sort of the economics here, and again back to the China theme. And I do think to some extent that the sort of recovery that we're looking for in China is to some extent going to be reverting back to what many of us before the pandemic were sort of describing as the old China versus the new China. So we'd had this big transformation in terms of China was now a sort of service-driven, consumer-driven economy. The heavy industrial export sectors weren't going to be such a big driver, and that had quite important implications. As we've come out of this pandemic, because the consumer has been hit hard, in order to keep growth going, I know the government have dropped their official growth target, but growth is still important to them. Don't think for 1 minute that growth doesn't matter in China. It clearly does. In order to achieve that growth, in a way, they are looking at some of the more traditional industries. We're seeing a pickup in credit growth. We're seeing a pickup in infrastructure, and so in some sense that might help economies that are sort of more geared into the what we were calling the old China economy than elsewhere. So it might actually help some of those hard commodity producers a little bit, help the rest of Asia a little bit. So I think that might be an interesting economic theme to watch. At the end of the day, the nature of the shock is so unusual relative to the sorts of recessions we've had before in terms of the breadth of it. Almost every country has been affected by this very, very aggressively. So in a way, it's kind of quite hard to draw these sort of relative strength of recovery story. It's not so easy. I think one important aspect of that to look at, though, is the extent of macroeconomic policy easing, which has varied a lot. I mean, I showed you that chart showing it's been massive, and but it's been a lot stronger in the developed countries than in emerging market countries. Some emerging markets have really not engaged in much fiscal easing at all. So you look at a country like India, a country like Mexico, they haven't really announced very large fiscal stimulus packages, where we had a very big package in Brazil, for instance. So I think that differential degree of policy easing might be an interesting theme as well as we watch these economies, hopefully recover.
Great, Mark. Do you have anything to add to that?
No, I think that sums it up.
Okay, so this one I can throw back to you for now, Mark. Which frontier economies would you say are best positioned to issue bonds within the next few years? And what's your outlook on India, Ireland, and Singapore?
So we're getting a little bit out of my comfort zone in terms of the markets that I cover. India is a very interesting economy. There kind of is in India an inability to kind of get out of their own way. I think the perception is that India really has not been growing, to the degree of its potential. I think there's massive potential, massive population, of course. Huge opportunity for middle class growth, but there have been a number of structural and political and other issues in India that have held them out, have held them back rather. I spent a number of years at Standard Chartered Bank, which, as you may know, has a significant interest and footprint in Africa, and I think that a number of African countries, on the frontier side, have real opportunities for growth. Botswana, Nigeria. Again, I'm a little out of my comfort zone, but countries that I know a bit about that I think are well positioned. The issue there is, Africa as a continent has a pretty sizable economy, but it's 40 individual countries, 40 very different individual countries, and it's really on a case-by-case basis. And finding one that has the necessary political, social, economic independence of the central bank, et cetera, in place to attract independent investors, as well as the size of the economy, is a bit of a filtering experiment.
Okay, and Brian?
On the India story, I mean, this was the country that we made the biggest adjustment in our forecast to recently. We're now looking at -5% this year, and as I said, that's primarily because of the lockdown, but also we don't. The lockdown is now starting to ease in India, but we don't really see much scope for a rapid recovery in the second half of the calendar year in India, partly because, as I mentioned, that fiscal easing has not been very substantial. I think a very large headline package was announced by the government, but when we looked into the details, we think it's more like sort of 1 or 2% of GDP easing, so quite quite restrained. So there's not going to be much fiscal support for getting the economy back. Obviously, there's a very large informal sector of the economy, which means that the income shock, the ability of the government to sort of cushion the blow in the way that we've seen, say, in Europe with these employment subsidy schemes, very hard for them to do that in India, given the informality of the economy. So the income shock and the consumer shock going to be that much bigger. And then also, these lingering problems in the financial sector in India, both in terms of the state banks and the non-bank financial sector, which has been really struggling over the last couple of years, and has been a source of weakness in the economy. Even before the pandemic, there were some very weak numbers being printed in India essentially because of a credit crunch. Those non-bank financial companies were providing a lot of marginal credit to the economy, and then when there was a liquidity squeeze, it really started to affect consumer durable spending. There was a lot of credit finance spending that slowed down very sharply. They've not really sorted those issues out. So I think our banking team have been quite negative on the Indian banking sector. So I think that's an area where the Indian economy, I think, is probably really going to be struggling through the rest of this calendar year. We don't see positive year-on-year growth emerging until early 2021.
Okay, thank you very much for that, Brian. I have one more question. I think I'll start with you for this one. It would be about the recent social bond issuing on the Eurobond market. If you can have any opinions on that.
Sure. Yeah, so this has been an issue that's been discussed and debated for years and years, and whether or not we're going to have a sort of overt debt mutualization and the sort of establishment of some sort of federal borrowing entity in Europe. And we've always thought that is probably going to be a very long time before we get to that point. It does look as if the pandemic has changed things in quite a material way. I mean, we don't yet have sign off on this. So there's a couple of big European meetings coming up. I think there's one this week and a key one next week, where this will be discussed at the EU Council of Ministers. But if it's approved, then potentially we are looking at quite substantial debt issuance from the sort of centralized European entity. The European Union would be borrowing and then distributing those monies partly in loans, partly in the form of grants to member states. So it will be a big change if it happens, and no doubt about it. Now it wouldn't suddenly become federal Europe overnight, but it would be quite it's quite significant. The fact that the Germans are behind this. I know we still have a number of countries that seem more skeptical and less supportive, the so-called frugal four. But with France and Germany both behind it, there looks to be a good chance that this might actually happen. So in terms of those concerns that were clearly very strong in 2012 about the sort of integrity of the Eurozone project, and this is one of the areas that everybody was looking to see there could be this strengthening of the resilience of the architecture of the Eurozone. And if we move down this route and we do get this approved, it's quite big numbers in terms of I think we're talking 5, 6, 7% GDP involved. So it's quite a big change if it happens, definitely.
And I'm guessing, Mark, that's probably outside of your area of interest, being on the other side of the pond. But do you have anything to that?
I do not. I defer to Brian entirely on that one.
Yeah, and I feel for you, I've got a question, and we're going to start wrapping up the discussion now because at 1:30, so we're going to go on to the next part of it. But would you have anything to say, Mark, about Brazilian Airlines? There's a question there about Go.
Yeah, I did see that one coming on the rack up there. So so look, I think as a group, Brazilian Airlines have had the same impact as global airlines, U.S. airlines, and European airlines generally. The largest Brazilian airline, LATAM, which, as you may know, was a merger of the largest Brazilian airline, TAM, with a Chilean airline, LAN Chile, that 5 or 6 years ago, I don't recall exactly when, and they were the premier carrier from Latin America, arguably, and they are in reorganization as of a week ago, 2 weeks ago. So that kind of tells you where they are. Gol is a very significant player domestically in Brazil. They're a good, great airline. Brazil is a huge country, as some people don't fully appreciate, and so there's a lot of domestic air travel, and Gol is a big player in that, and that traffic is down. So there are really three airlines in Brazil that you need to keep an eye on, which are LATAM, Gol, and Azul, which is David Neeleman, the creator of JetBlue in the U.S., who happened to grow up in Brazil, actually, conveniently enough. Started that airline down there. I think all three of them are having the same issues that airlines are having globally. Neeleman's airline, like JetBlue in the U.S., like Ryanair, et cetera, and some others in Europe. I mean, they're kind of bargain airlines. Maybe they'll do relatively better because their costs are down. Like Southwest in the U.S. is one of the least hard hits, but there's nothing good about what's going on there right now.
Thank you, Mark. And Ryan, would you like to add anything about the airline industry in general, if not specifically about Brazil?
Nothing specifically on Brazil, but I just would recommend people look at the research that was published today or yesterday by our corporate team, where they're essentially looking, over the next 2 years, what's the sort of road back from all this for the corporate sector, and a very, very granular look across all the sectors that we rate, and the airline sector is clearly one of the weakest in terms of how sustained we think the crunch to revenues is going to be. It's going to be if my macro view is looking pretty sobering, that particular sector is way below that path.
Okay, thank you very much, Brian. And I think if neither of you have anything more to add on what we've discussed, I would start to move on to the next part of the seminar. And I would thank you both very, very much for your contributions today. It's been very, very interesting, and your time is very, very much appreciated. So I don't know if you want to hang around for the next, let's say, 15 minutes while I will present the platform. But Mark, I know you're very familiar with it, a daily user. So again, thank you. And from now, what I'm going to do is, if you guys don't mind turning off your cameras and your microphones, and I will move on to a brief presentation about the Cbonds platform. So what I'm going to do is turn on my screen, and I will do a brief presentation of the Cbonds platform. Okay, so I hope everyone can see my screen okay. I can confirm that's working. Maria? Yeah, I'll take it that everything is working fine then.
Oh, yes.
Perfect, perfect, perfect. Okay, thank you very much, Maria. So I will start by talking about Cbonds. The platform and our data are available in a number of different ways. So data can be viewed via the mobile app, by the Excel add-in, which we have, which can be installed into your Excel, and additionally by an API, a direct source. But what we're going to talk about today is our website, which is the first and primary source of Cbonds data. So what I'm going to do is I'm going to talk first about the heart of the Cbonds website, which is our bond search, which is really where everything starts when we talk about the Cbonds platform. So I'm going to open up the bond search, and I am going to perform a couple of simple bond searches to show how you'd use the Cbonds platform to search for data, to search for interesting investment ideas in bond markets. So we have a multifaceted input selection here, where we can search for bonds based on very, very many different criteria. So I think what we'll start off by doing, because we've been focusing on the UK and the US, today I'll start by looking for a number of different British bonds for the UK, and we will look for corporate bonds. We can search for a number of different industries. So let's search for agriculture and communication. Actually, construction, engineering, food industry, we mentioned healthcare, utilities, and transportation. Okay, so we have a number of different industries here. Then by default, outstanding bonds are selected. We'll leave it like that. We will look for Eurobonds, and we will look in GBP and USD. So we'll just select the currency like this, GBP, and then we will select additionally USD. All right, and we will look at all bonds that have been placed since the beginning of this year, so since the 1st of January. If we wanted to, we could put in yield there, search for just high yield bonds, for example, put minimum, maximum percentage. We won't do that today. We have data from all of the main ratings agencies. So what I'll do is obviously Fitch, select this range here. Yeah. Bond classification, we can search for either only for specific types of bonds, or we can exclude specific issues. So what I'll do now to make things a little more straightforward is just exclude a few of these issues here, and then I will perform a simple bond search. So while we wait, we'll soon be presented with a nice list of bonds. Here we go. We found, matching those criteria, about 17 bonds. And here we go. We'll search with them here. We can export them very easily to Excel by just clicking here. And if we would like to, and we have a search like the one I've just done, if it's a criteria that we're going to be using the same kind of search over and over again, what we can do here is press Save Query. We can save this query, and the search I've just performed will then be accessible in future, and we can just refer back to it by saving it here. So we just put test and just save like that, and that query has been saved. Okay, I will do one more bond search. We'll clear this, and I will then do another bond search, let's say for the American market. So let's just put in USA. Again, we'll do corporate bonds. We'll select a few different industries. Petrobras, communications, construction engineering, food industry, gas, transportation. All right. So again, we just want to have outstanding bonds because I deselected everything that's been removed. I can pick, let's say, international bonds, and then let's say in USD. And if we wanted to, we could say in euros as well. There are multiple currency denominations there. We can just put in euros as well. Okay, so we're going to do the same thing again. All bonds placed this year, includes the January onwards. Same with the ratings here. So we're going to pick the same selection, any two, same range, and we're going to exclude the same bonds that we just did. So we now should get a nice selection. I seem to have missed something here. So I'll just re-perform my search. Country of the USA. Select the corporate bonds. Select industries. Type, national, same placement at the beginning of the year. We'll do the same with the ratings. which is exactly the same classification. And we will do a search. So here we go. Nice selection of Cbonds. We can take a flick through. We can pick a bond as an example. Let's say AT&T, and we can look at the bond emission page. So here at the top, we have some of the basic information: type of bond, the outstanding amount, placement, redemption. Here we have files. So we've got here the prospectus. We have the best selection of prospectuses on the market. So our prospectus selection is fantastic. You can download them just by clicking on here. Here we've got trading chart with the pricing data. So you can look at the pricing data up to the last 3 years. The bond was issued that long ago. We've got the pricing, we've got the yield here, the G spread. And what's nice as well, we can also make a map with all of the emissions from a single issuer. So here we go, all of the different bonds mapped out from AT&T. We can scroll down and we can see here all the different pricing sources. So currently Cbonds receives pricing data from 300 different pricing sources. What we'll see here is the Cbonds estimation. That is a statistical average, weighted average of all of the different pricing data that we aggregate on our platform. Scrolling down a little bit more, we can see the issue information, amount of the issue, details of the cash flow, on the coupon payments, early redemption terms, placement identifiers, and of course ratings from the 3 main ratings agencies, and if applicable, also local agencies. So in this case not, but if applicable, there will also be other ratings data from different agencies. So let's say, for example, we found a bond here that we quite like, and we would like to add it to our watch list. We would like to monitor it and keep our eyes on it in the future. So we have a great watch list tool where we can monitor up to 250 different bonds, and those are our investments. So we can just add, let's take the Cbonds estimation in this case as the pricing data. We have to take a pricing source. We will save it, and then this bond will have been added to my personal watch list. So let's take a look at the watch list tool. We'll go into tools, we'll take a look at watch list, and now we can see all the bonds that I've added in the past to my watch list, and we can also see the AT&T bond that I've added today. We can see its movements here. Now the watch list will be synchronized across all of your devices, so if you're using the mobile app as well, you'll log in and you'll have access to all of the bonds in your watch list. So you have this here. And what you might like to do is set up email reminders. So to be notified if certain things change. It's very easy to do in the watch list. You click on the little bell tool here and set notifications, and you can pick, for example, coupon payments or redemption or news about the issue or ratings. Very, very simple to do. You'd save it and it'll be sent to your email. I don't really want to do it right now. Another thing you can do also is monitor your pricing changes. So let's see the bond we just got now. We might want to set up email notifications for changes in the price. So we can go here to the right-hand side, click on the little bell here, and then either changes in price or yield, indicative price, we can put plus or minus, so if it goes more than or less than, and we can save it, and we'll also get email alerts for those developments. So that, in a nutshell, is our watch list. Moving on from that, we do have a news section, so market news, where you will find details of everything that's going on. What happens? My internet's a little slow today. Everything going on in the bond market. So new bonds being issued, different data can be accumulated here, and you have these facilities here to sort that data as well. Now, one other thing we've got, which is more recent, now Cbonds obviously has always been focused on the bond markets, but we thought it'd be a great idea if we can put everything in one place. So now we have started to look at stock data as well. We collect stock data. I know it's very easy to access this on every internet source, but it's great just to have everything in one place. So with the new Cbonds platform, it's quite easy to track stock as well. So let's do a quick search for stock let's say country UK. Let's pick a couple of industries. We'll leave those blank and we will do quick search. Here we are, nice list of stock matching there. And we could do the same, we can clear the form, and we can do the same in the States. We're going to pick some communication stock and do a quick search. So we'll take a look at one of the emissions. Let's take a look back at AT2. Some of the data here. And what we might want to do as well is, so here we have stock exchange, the pricing. You can scroll through here to a 3-year period. And scroll down, issue information again, other stock related to the issuer, and the holders. So let's use this function here, which we haven't touched upon yet. Here we can just search for any interesting bond or stock in any company by just entering the name of the company. So I'll just do a very well-known one, very topical right now, Amazon.com. And in a second or two, we should be able to see that we have 29 bonds listed from Amazon.com and 2 stocks. So let's open the ordinary Amazon stock. And here we see the data, 1 month, 3 months, 6 months. Okay, and again, as we've seen before, the IFRS documents, which can also be very, very handy. We'll do the same for another well-known one, for Tesla. Takes a moment for everything to compute, so 8 bonds there, and we can take a look at their stock. So another nice, easy to use function as well. This will wrap things up a little bit, but we'll go and take one more little look at another tool. That's the indices. So if we go into indices, we can do a quick index search, and we can use this to do things like compare credit default swaps across different markets. So to make it nice and easy, we will search for, let's say, the Italian credit default swaps for 5 years. So just type in CDS 5-year Italy, and we should be able to find the credit default swaps for Italy. We can click on Get Values, and here we have it. Click on there, and we will be presented now with a nice snapshot over the last year or the last 5 years. What's in the period? Now, we might want to compare what's going on in Italy with another country, a similar country, to make a nice comparison. So let's pick Portugal. We'll do the same for Portugal. We'll do credit default swaps, 5-year, has to be 5-year to match, to compare like with like, and then let's say Portugal. And there we go. We have a nice looking comparison of CDS for the last 5 years. Now, there's an awful lot more that the platform can do, and a lot more that we'd like to talk about, of course, but we are limited in time, and we're almost at the end of our scheduled time. So I thank everyone who has stuck with us for this period. I hope that it's been productive and enjoyable. Now, Maria has very kindly put my contact details up on the screen. You're all very welcome to contact me, and I would invite you all, if you're not already Cbonds subscribers, invite you all to get in touch and test the platform for yourself. So I invite you all to take a 1-week free trial of the Cbonds platform. You can contact me there by email or by WhatsApp. You can see my WhatsApp number there. And at any time, if you have any questions, I'll be very, very happy to help. I'm pretty much always online these days, so it doesn't matter if you're in the States or the UK or anywhere else. I'll be delighted to hear from you. And I'll also send an email around to confirm my contact details after the presentation, so about an hour afterwards. We'll also send around the slides, which have been very, very fascinating. So once again, I would very much like to thank Mark and Brian for their time today, and then thank everyone else who's taken the time to participate, to ask questions, and to view this seminar. So it's been a great pleasure to be involved in this, and I hope to be in contact with all of you in the very near future regarding testing the platform and talking through your data needs with you. So thank you, everyone, and have a great evening.